My guest today, I think most of you probably know, I consider amongst the foremost thinkers on the topic of what people were calling Web3. Let's call it blockchain networks. Please give a welcome to Chris Dixon, Andreessen Horowitz Crypto Fund. Now, Chris, I want to ask you to describe something that I found confusing, and I think you educated me a lot just by publicly sharing information, and that's this. Most of us kind of saw blockchain networks as databases, or people were calling them ledgers, and you've argued that it's more like virtual computers. Can you explain this metaphor and why you think it's so important?
Yeah, so thank you for having me, and this is a really incredible conference, and thank you all for being here. If you take there's good and bad blockchains. A blockchain is a software construct. You can do it poorly or well. If you take a good one like Ethereum is a good example, it's a computer in the kind of the original Alan Turing sense of a computer, and you can write software for it, and you write applications. It's a near Turing complete computer, and it stores information and operates on that information. It happens to be a computer that runs on top of a network of other computers, and it does that for a specific reason, which is the key feature of a blockchain. Like with every new type of computer, it has sort of new properties and new reasons you might want to write applications for it. The key new property of a blockchain is that the software you can make strong commitments about how it will behave in the future. And those commitments can be used in financial ways, as people are familiar with things like Bitcoin, where Bitcoin makes commitments like there'll only ever be 21 million Bitcoins, and that's one of the necessary but not sufficient conditions for Bitcoins to have value. But Ethereum, which came out in 2015, and then there's a bunch of other blockchains since then, really expand this kind of surface area of what can be built. And so we're seeing people now build social networks and games, and really any kind of internet service you can now build on a blockchain. And in my book, I go in detail to talk about why one would want to do that, and all the specific new kind of features of these internet services that differentiate them from prior types of internet services that we're used to.
We're going to go on a journey through your book. So let me first tell people it's called Read, Write, Own. I actually incredibly recommend all of you to read this, because if anyone asks you about crypto, if they ask you about blockchains or decisions about what to build, Chris does a really good job of laying out what it is and what it's not. And so you have to be smart to read this book. So luckily, I think everyone here can read it. Let's first go through the three different things: read, write, read, write, own, rather. The read phase of the internet we grew up with, and there were open protocols. You call them protocol networks, HTTP, HTML, SMTP, and we take for granted the openness. Talk about what those days were like and why that was important.
Yeah, I mean, so for folks who probably know, the internet goes back to the 70s, but the modern internet began, most people think of it in the 90s with Mosaic and Netscape and the rise of the commercial internet. And the read-write, by the way, is not my term. This was a common term in the 2000s. The idea was that in the 90s, people had mostly built things that kind of took things from the offline world and put them in the online world. So most websites looked kind of more like magazines or brochures, and they were really kind of one way. You would consume information. And the killer app of the 90s was Google. You'd search for something, search engines, and you'd get information. So it was very good at democratizing the consumption of information. In the early 2000s, which is when I became an entrepreneur, there was this thing called the Web 2, or the read-write movement, as they called it. And the idea was, hey, the internet can be more than just a one-way consumption device. You can not only democratize information consumption, but also information publishing. And that was the rise initially of blogging, but then like Twitter and social media. And the own refers to if what I believe is right, and we have a new era of internet services, the key feature in this new era is that you enable digital ownership, and that has all sorts of features that.
If I could, because we're going to spend a whole bunch of time on own, I think it's the important idea that you want to share. But let's first talk about what went wrong in read write, because I think to set us up. So let me frame it this way, which is, I think when you and I started investing in blogging and doing all the things, we both had sort of an optimism that we saw all of this great stuff being built and innovation, and the next wave of things were going to happen, and openness and democracy and capitalism were going to flourish. that didn't really happen.
That's right.
So talk about the first kind of network you talk about is protocol networks. The second type is corporate networks, and that's really what's wrong with that.
Yeah, so the 2000s, I think of it as, and so like for those, like I got, the reason I work on the internet, maybe like you, Mark, in technology, is I was very inspired by the 90s vision of the internet as a democratically opened, permissionless network where anyone could go and put up a website, a creative person, an entrepreneur, and you get your little plot of land, you get your website, and you can build something, and you can build a direct relationship with your audience. And for those who don't know, there were all of these kind of visions and discussions at the time of this kind of new era that would be unlocked. And I think we lost our way in the 2000s. Today it's essentially 5 companies control the internet. I go through the stats in the book, but top 1% of social networks account for 95% of traffic. Same with search engines, top 5 tech companies, 50% of NASDAQ 100 market cap. All of that is headed towards greater and greater consolidation. With AI, as powerful and important as AI is, a lot of the trends are towards greater consolidation. I think we're very close to entering a period where there's sort of 4 internet services, which is very, very different so specifically to the 2000s. I kind of argue in the book, and I go through in detail, that we basically made a Faustian bargain in the 2000s. We wanted more expressive, powerful internet services like Facebook and Twitter, but in that process, we handed over power to a new
overlord.
And they're very there was a whole kind of debate between RSS, which is an open way to do social networking, and these proprietary corporate systems. And the reality is the corporate systems just had more money, they went faster, they subsidized hosting costs, and did a bunch of things, which had a lot of good effects. We have 5 billion people that, the internet's wonderful, I'm pro-tech, but in the process, we handed over power to these 5 companies, which have just further consolidated through network effects.
If I could set you up for this, because I think your book does a really good job of framing this.
Yeah.
You call it attract and extract. Attract and extract. Describe that concept and why that's, in your mind, problematic in corporate networks.
Every network, I argue, that's owned by a company, and this could be anything from Microsoft back in the day, they owned a developer network on the Windows platform, to iOS today. Anyone who's a software developer is very upset with iOS today. It's very bad. To people that built, for those who were there was a huge venture wave investing in Twitter apps. We were just talking about it before, that you had some investments there. I did. Facebook apps, Zynga. Every one of these networks goes through the same process that we've now have 50 years of data, which is they start off and they're kind of they want to attract users and media properties and software developers and anyone who will, they're scrappy startups trying to get traction. And so they do everything they can to attract people. As they go up the kind of technology adoption S-curve, at some point, right, they saturate the market, and they have to essentially start turning the screws on all these network participants to squeeze more profit out of the system. You see it every day. Every day you go to Google, there's more search ads. Every day you go to Amazon, there's more search ads. Facebook and Twitter, 2012 or so, shut off RSS, shut off third-party development. Apple has turned the screws. This happens over and over. They basically can't help themselves once they have network effects and they have you locked in. And once growth tapers through sort of organic growth, because they're just not growing as fast from user growth, they turn the screws. And what happens from the outside, if you're a software developer or a creative person on one of these platforms, you just talk to creative people in LA who build audiences on TikTok or something, and they will tell you that at first it grows quickly, and then the algorithms tweak and change, and it's very, very hard for them to make money. It's very hard for them to maintain their audiences. And this is just profit maximization. These companies are turning the dials, and they're making sure that you have to buy your way back or do other things, or they're diversifying their supply chain and so forth. And so what this has created is this dynamic where startups don't want to build on these platforms. Sometimes you have to, like iOS, but people have, venture investment in building on top of social networks ended 10 years ago. I mean, go to your top 20 apps in the App Store, and how many of those companies were started in the last 10 years? I don't think any of them. I mean, even TikTok, arguably, but ByteDance was 2011. But for the most part, that whole era of consumer internet and everything else, because you now have these 5 gatekeepers, has ended.
Which means we're killing innovation, right?
That people ask me sometimes, aren't you sort of talking your book? I guess I am, in the sense that I'm in the venture capital business, I'm in the innovation business, and we want a dynamic level playing field for startups. I mean, this is also open source software with respect to AI and blockchains and all these things. We want systems that are open and composable and people can build on them, so we have a dynamic internet, right? I think.
To describe one of the concepts, and you talk about this in your book, and you've hinted at it here, we funded a company, they're in the room, called Kin, and they came out of Facebook and Instagram, and they really got me to realize that if you're a brand marketing inside of Instagram, as you said in the attract phase, you go build an audience and you put out a bunch of posts, and all of a sudden people start buying your product and it feels great. And then all of a sudden your posts stop appearing in front of audiences and they turn back the dial.
And you have to buy your way back.
Yes. And it was like sub 20% of your audience then started seeing it, unless you do paid promotion. And that's the extract phase. Let's talk a little bit about the third type of network. So the first type of network, protocol network, was open, a lot of innovation, creativity, new companies being created. The second was the rise of the corporate networks. They ended up taking, I think in your book you say, the rake on everything except for YouTube, maybe in iOS, is 99%.
Yeah.
So they're taking everything. The blockchain network, which is what you hope the future will look like, does not do that. Explain why the rakes end up going down to, I think, 1.5 to 2.5%, and what that does for creators.
Yeah, and so as you alluded to, with like you think about why do journalists today move over to email newsletters like Substack and away from social networks, is because they can actually collect money from their audience and keep most of the money. And Substack takes, I think it's 10%, so the creator creates 90%. You get zero. They don't share any of the revenue on the social networks, and they don't even let you link and do other things. And so the early internet let you build a direct relationship. And my argument, my kind of core argument throughout the book, is that internet services built on blockchains, if built correctly, they can be built incorrectly, if built correctly, are kind of the best of both worlds. You get the advanced functionality of these corporate networks like Facebook and Twitter, and you can build really advanced internet services, but you get the low take rates, the direct relationship with your audience, the predictable commitments to developers, and all the things that people loved about the early networks.
Yeah.
So specifically with take rates, like the core feature, as I mentioned before, of a blockchain is it commits ahead of time to its rules.
Yeah.
And so you commit ahead of time in a blockchain, my take rate will be, my take rate will be 1%.
And that's encoded in the software.
That's encoded in the software. It's everything on a blockchain is open source software that can't, that if written correctly, it cannot be changed.
If the group corporate governance agrees to change it.
It depends. Yes, there are nuances into how these systems are governed, but they can be built. It's software. It can be built and again, like an important point, which I hope we talk about, is that there's obviously bad uses of blockchain too, which we've seen. With FTX and everything else. You can use a hammer to build a house or destroy a house. What I try to do in the book is to show the positive use case. There are obviously negative use cases, and like in a rational world, we'd have policies and other kinds of things that encourage the good and discourage the bad. But
I'm definitely going to go to FTX, so I promise we'll talk about it. But I want to pick up on another really important concept in your book. I want to talk a bit about tokens. Now, I think when I talk to people who kind of understand the space but don't really, they often say to me, I always believed in blockchains, always. I just don't believe in crypto. And I said, you can't believe in one and not the other. Like they're inextricably linked. You kind of talk a little bit more about tokens as a more politically correct term and less frothy. Talk about why tokens are necessary for blockchains to be successful.
Yeah. So again, maybe talking about Ethereum would be a good example, which I talk about in the book. So Ethereum is this sort of shared supercomputer that people can write applications on, and it has a microeconomy. So the way it works is sort of like old style mainframes, is you actually have to pay, when you write software for it, you pay to run that software. And you pay using the token. And so it's got this little microeconomy. And then in turn, those tokens are used to pay what are called validators, which are people that actually host the software. Because you need a business model to get people to run the software, right? You can't people aren't just going to run software and pay for electricity for free. And so it's got a little microeconomy. And in the last 12 months, I think people paid about $2 billion, developers did, to use the Ethereum network. And that $2 billion was then redistributed out to the people that host the network, sort of like the AWS.
Almost like paying for your AWS.
Yeah, right? It's a lot like AWS, but it's this little microeconomy, and it's very interesting. And I go through it in the book. I have a section on so this kind of token design section where I explain it. It's a very interesting area where you can design these little microeconomies. Actually inspired a lot by video games. So a lot of modern video games, for those who know, like EVE Online and Clash of Royale and League of Legends, they have these little microeconomies in them, and a lot of these blockchains have similar ideas, and you have you sort of design it in a way that it kind of hits an equilibrium state. So that's the right way to use tokens. There's a wrong way to use tokens, which is you take those things, you put them on a website posted in the Bahamas, and then you market them and tell everyone they're going to get rich, right? And which is unfortunately what happened in 2021 and 22.
But you call it the casino and the computer.
Yeah.
Why did the casino happen? And what makes you think we're going to settle into some normalcy where it's not perceived as
so I've been in this space a long time. I obviously, the vision I believe in is in the book, and for those interested, that's where I tried. That's why I wanted to write the book. So the vision, I didn't feel like that vision was out there.
Yeah.
Like someone had put it in the book. I feel like people came along and co-opted a lot of that vision and used it in the wrong way, and that was very disappointing.
That's happened in every market.
Yeah, and I think to some extent that has happened. Look, I think people have forgotten a lot
Telephone
of this.
industry.
Early internet, 90s internet had a lot of crazy bad shit. Like there's, the whole history of the internet has had this kind of stuff. It gets exacerbated because there's money involved. I would argue that the policy, the kind of regulatory approach has been like, there's this very perverse set of incentives right now, which is if I create what's called a meme coin, if I create Chris coin, it has no purpose, that's legal. If I create Chris coin and then build a service behind it, that's where you run into regulatory issues. And that's not the right set of incentives. So ironically, like a lot of the sort of what we would think of as the bad speculative stuff is actually the things that are more legal. So we're very involved in policy for that reason. We think that's partly a role for policymakers. Partly this is human nature. Human nature likes, it's just like it's an easier news story to talk about fortunes won and lost than it is to talk about a virtual shared computer.
What went wrong with FTX? I know you have a view on that.
I mean, look, so we were not investors. We were one of the only large VCs that were not investors in FTX. We were early investors in Coinbase. I was on the board of Coinbase for a long time. They are highly regulated. They've done KYC AML since the beginning. Every user has to show their driver's license. They have a huge compliance operation. They file SARS reports. They do all the things that any financial institution would do. From my perspective, you had FTX and Binance and all these other offshore exchanges that didn't do that and were located offshore for a reason. And then that, I mean, look, in the case of FTX, like they played fast and loose. I guess apparently in FTX, the courts have decided they did more than that, and unfortunately, a lot of consumers were hurt by that. And
I think one great thing about Coinbase is maybe talk about corporate governance. They had a strong board, very experienced board members. FTX, I think famously,
I don't think they
did not have the same level of oversight, and people wrote checks without governing rights.
Well, and like Brian, the founders of Coinbase, so I joined Andreessen Horowitz beginning of 2013, and I was interested in this topic and spent the year looking for an investment, and finally invested in them in November 2013. And that was the reason we invested, was they were the team we met that took regulation and compliance the most seriously. And so it was just kind of hard to find people like that. And they took it very seriously from day one. They were based in the Bay Area, and they just like, look, we're going to make this a core competency, and we're going to be highly regulated. And for a long time, you talked to most people in the venture community 3 years ago, and it was like, Coinbase is the loser who's getting lapped. I think their approach has now been validated.
I think one of the things we talked a little bit backstage is, one of the casino elements that I saw were people doing ICOs, initial coin offerings, raising a bunch of money. Then all of a sudden they had money. And because in a private company, you're incentivized to have a long-term take on it because there's no liquidity for the stock. In crypto, like there was liquidity from day one. You kind of think a little bit differently about token governance. Explain that.
Yeah. I mean, so one of our main policies, so we go to DC a lot. We have a whole website full of policy proposals. We've had it for years prior to all the FTX stuff. And one of our core proposals is to have long lockups, and basically a set of regulatory milestones that projects have to hit to unlock those. But look, my view of Silicon Valley, having done this, for a long time, is that one of the reasons it works is there's a long-term, it's obviously capitalistic and people are trying to get rich, but it's a long-term capitalism, right? I think that's really the core advantage of venture capital and of startups is it's a 10-year, you know this, 10-year fund. It really are 10-year fund. The LPs here know that.
They are not really 10-year funds. They're really 15-year funds called 10-year funds.
It's a very slow asset class. But that's a feature, I think. It's a feature, not a bug, because it takes 10 years to build a really powerful, important internet service is the reality, right? And I think the same thing applies here. I think there's a whole bunch of advantages to this architecture, but it doesn't change the fundamental rules of human nature and projects, that they take a long time. And the financial aspects need to be aligned with that. And they aren't right now. And with the ICOs, they weren't. And like there were, ICO is a weird term. It's one of these vague terms. There were things that were okay and there were definitely bad things too.
Yeah.
By the way, at that time, the regulators cleaned that up pretty quickly and in a good way. So, there's an important role here for regulators in these things.
There's a topic I'd really like you to talk about because it's really complicated and nuanced, the idea of NFTs. In some people's mind, it's just synonymous with apes or cyberpunks or whatever. Talk about non-fungible tokens, like actually what it means, why you think it's important. And I know I believe one of the things you care about is how do you get more money in the hands of artists and creators and allow them to participate in the economy more. Can you talk about your vision for NFTs?
Yeah, just two starting things. NFTs were kind of standardized in 2020, so it's literally a 4-year-old technology. Number two, there were 8.6 billion in sales last year, so sort of after NFTs died. Like OpenSea, which were involved, all the stats are public. I think it's at a $1.8 billion run rate. So like it's still a very significant thing. Like my view is what's exciting about them is it's a way for so what an NFT fundamentally is it's a way for internet users to own something, and you can own that thing you own can be an avatar, which is what we saw before, but it can also be, for example, we have a wave of social networks where what you own is your Twitter handle or your social media handle that is contained in an NFT. And you also own your following, your social graph, which what that means is if you don't like how the social network is behaving, you can leave and take that with you the same way you can leave. If you don't like a website hosting provider, you can take your domain name with you, right? So it can represent that. It can represent a real world asset. We're seeing a lot of that out of some of the big financial institutions where it represents, a stock or a bond or whatever, some other kind of thing. It's a very generalized concept. I have a section on tokens and NFTs in the book. It's a very general concept. It's 4 years old. Some of the early incarnations of that concept were silly, as were some of the early websites, as were some of the early soft video games. Like, don't confuse the essence and the potential of a technology with the early instantiations of it. Right? They are not the same thing, and so you need to kind of look and there's a lot so you mentioned creators. Like, there's a bunch of people doing interesting things around. So Spotify, their own stats. 8 million artists and 14,000 make $50,000 a year more. Like, ask any independent artist. Less. Yes, sorry. It's 50, so it's a very, very tiny fraction make kind of the average American.
Not a lot of people make.
Yeah, just ask your friends who do music if they make money on that. And so, for example, there's a series of startups that are allowing musicians to sell digital collectibles, backstage passes, and those are represented as NFTs. So it's an interesting new space for artists and creative people to explore as a way to.
So just in the interest of time, because we don't have a lot of it, in the book you talk about like AI really as a concept started 70 years ago.
Yeah.
Investments in it started more than 10 years ago. So things take time. Blockchains are new. Cryptos is relatively new. What do you think, in a quick answer, the most compelling use cases in your mind that will develop over the next 3 to 7 years?
There are things that are at scale I think people aren't paying attention to, like stablecoins, 600 billion in transactions last month. That's growing very quickly.
Describe a stablecoin.
Stablecoin is, so the most popular one is USDC. It's $1 represented as a token and like on Ethereum. And that happened anywhere in the world. You can take $1 and you can send it to somebody. And that's become very popular, especially in the developing world where access to the dollar is considered valuable. It's not something we experience in the US because we have dollars, already. That's been growing very quickly. NFTs, I think, are bigger than people realize, and I think coming back, I hope.
I just tell you, Chris, real quickly, when I was skeptical maybe 8 or 9 years ago, I had lunch with Mark Andreessen, and he was the one who persuaded me of the importance of crypto. And he basically said, we in the US, we take a lot of this for granted because the dollar, except for like the crazy people who are worried about the de-dollarization. Maybe they're not crazy, but maybe they're extreme element. But then he says, like, if you have money in Argentina and you've seen hyperinflation, or Turkey, or you have money in China, India, where it's harder to move your money out of the country and you're worried what might happen, having even some variety in the currency valuation, you will accept that in exchange for not feeling like your capital's tied to bad leadership.
The last stat I saw, 18% of Argentinians have stablecoins. So like it's very popular in countries where there's a highly volatile.
And I think that's a good vision for where things could ultimately go. Last question for you, and has to be a quick answer. I apologize. Okay. What is a realistic time frame? Like, I said to our LPs at our annual meeting, being too early is the same as being wrong in venture capital. What's a realistic time frame?
I think I sort of think we were on track to Ethereum came out in 2015, a whole bunch of improvements in infrastructure. Things were going well. I think of it as we had this sort of catastrophic setback through FTX and a bunch of other bad actors getting involved, which set it back a couple of years. I believe now we have a lot of signs of really interesting new products being built, better infrastructure. So look, I hope we're back on track now and gonna see some really mainstream applications in the next couple of years. But I've found in my career that predicting what happens is easier than predicting when it will happen. And so, that's my hope, but we'll see.
So who the fuck knows? Anyway, big thank you for Chris Dixon.
Thank you all.